get started on our last session. So the presenter for the last paper is Tingting Liu from the Iowa State. She's going to present her paper on the role of external regulators in the M&A transactions. Tingting, the floor is yours.
Thank you, Sterling, for the introduction. I would like to thank the organizer for including our paper on the program. And also, I would like to thank everybody for staying, especially people in the United States, because it's getting pretty late. And I'm very happy to have this opportunity to present this paper. This is truly a teamwork. So this is a joint work with Tao, I think, also in the audience. Both Tao and I are finance people, and we have Erin and Jasmine, who are our accounting experts. As I said, this is a teamwork, and it's been a pleasure working on this project. So as the title suggests and Sterling introduced, our paper looks at how SEC common letters affect mergers and acquisitions. So let me start with the motivation of our paper. So in mergers and acquisitions, there is severe information asymmetry problem because so many parties involved in M&A transaction. So we have information asymmetry between the acquirer and the bidder, and we have information asymmetry between managers and outside investors, like insider and outsiders. And we also have information asymmetry even among investors. So the M&A transaction is complicated, it involves a lot of steps. The prior literature, M&A is a huge literature, and no wonder there are many papers trying to document how all the parties use different ways to resolve this information asymmetry problem. So earlier studies focus on how method payment can help alleviate some of those information asymmetry problem, like bidders tend to use stock as a method of payment if the information asymmetry is really high between the bidder and the target. And also, later on, D'Angelo's accounting review paper shows target firms can hire investment banks and do independent valuation, which later disclosed in fairness opinion in the proxy statement. And this certified valuation, but basically the valuation provided by third party can help resolve disagreement among investors so they perceive the offer price is fair. Also, the conference call is another different channel, like bidders sometimes they hold a conference call on the merger announcement day or the day immediately following the announcement. So the purpose of holding conference call is to provide more information to investors. And finally, recent, I think JIE paper documents share auditor can also provide some information advantage if the same auditor previously audited both the bidder and the target side. So those are like voluntary, like firms, they have their own channels to reduce information asymmetry. But SEC, as an external regulator, the role can be very different. And the role of SEC specifically in the setting of common letter has been investigated, but mainly on periodic filings like 10K or annual reports. Recently, a few studies look at the SEC review process, like common letter issued on the transaction filings like IPO. This concurrent paper by Johnson et al. 2020, they are like one of the few studies look at M&A filing review process, but they focus on how the review process affects the post-merger accounting quality. But what we do, so we focus on how SEC review process affects the M&A process and ultimately the M&A outcomes. So our main research questions, we basically ask two very straightforward questions. What is the role of the SEC played in this process as external force or regulator in terms of reducing information asymmetry in this particular setting? Does the SEC review process affect deal outcomes in a positive way or maybe in a negative way? So just a very quick review of our findings. We do find the review process improved the likelihood of deal completion, also increase the probability of offer price revision, which doesn't happen very often. So this is economically significant because the public price revision happens about like 10% of our in our sample, and SEC review process seems to significantly affect that probability. And not surprisingly, the review process delays deal completion, like the duration between deal announcement and deal completion. So the background, I would like to briefly talk about the background of this filing process and review process. So as a publicly traded firm in the United States, the target firms are required to make a lot of disclosure, like filings, after they announce a deal publicly. So the SEC, so they start with the preliminary filing. The bottom part here, I think is quite useful, illustrating like the timeline of this quite complicated process. So deal announcement, that's the first time the market or outside investors learn about this deal, right? A target or a bidder is buying this target on a particular day at a certain price. So after the deal is announced, then firms, mainly target firms, because majority of the deals, like bidders, are not required to make any filings, but just in a few cases, like in tender offer or when bidders have to issue like a lot of shares, then they are required. So majority of the filings are made by the target firm. So target firms make those preliminary filing. SEC staff review those filings. They comment on some issues. They think this particular area needs more disclosure. I mean, they comment on the target firm managers, like you need to disclose those following information. So firms make amendments to their like filings. SEC has to clear the review process before the firm can issue the final like definitive proxy statements. And that definitive proxy statements has to be made like at least 2 weeks prior to the target shareholder meeting. So in the United States, because M&A is a really significant event, and most of the time shareholders have to vote on the deal so the deal can go through. So the shareholders, so the regulators require shareholders to have like at least 2 weeks to process the information, to get informed and make like the optimal decision. So the definitive filings have to be made like 10 or 20 days prior to the scheduled shareholder meeting. And before that, the SEC has to clear the review process. Then deal is completed, and comment letter, like the correspondence, like what the SEC commented on and how firm responded, gets disclosed. So the most important thing, the takeaway here is when SEC is issuing comment letters with a lot of issues that the firm had to respond, public investors, they do not know, like SEC is commenting or SEC is actually review those filings until the comment letter gets disclosed after the deal completion. So basically, SEC is not trying to signal to the public, we are investigating the filings for this particular deal. But the investors, they do get access to those amendment filings. Those are publicly available. So that's a very important institutional feature here to keep in mind. So what investors can observe is those additional disclosure made in those amendment filings, but they don't know if this additional information disclosure is induced by the SEC review process or not. And SEC, on the other hand, they just they try to provide as much information as possible, like without purposely signaling anything to the general public. So that's the background information. So here is an example, like the original filing made by a target firm. So in the proxy statement, the firm needs to disclose the fairness opinion valuation provided by this investment bank. So the investment bank, they use some valuation technique. They come up with a price range like $33 to $51. So that's the valuation range investment bank believes the target firm's share is worth. Then SEC commented on this disclosure saying you need to further describe the selection criteria, because that valuation range is based on a specific valuation technique called comparable company analysis, right? You need to disclose the identity of the comparable firms and how exactly you choose those publicly traded firms as a comparable firm. What are the selection criteria? And are there any firms actually meet that selection criteria but not included in your analysis? So you can see it's like it's sort of like our journal review process. You submit your preliminary filing, then the reviewer issue referee report with like 25 issues you have to address. And here is related to like the methodology, how exactly you come up with that price range, $33 to $51. And what's your like basically analysis to back up your this valuation range. So we can see firm response, like in response to the staff's comments, the company has modified the disclosure on page 36 and 37. So in terms of like our review process, like we prepare response to referee, then we also prepare a revised draft. So what investors can see is this revised draft disclosed as amendment filing publicly. But that response to the SEC comment reviewer has to be disclosed like after the deal is completed. So this information is disclosed in the amendment filing after the firm received the SEC comment letter with a list of issues the firm has to address, including this issue specifically commented on the fairness opinion. So we can see in the amendment filings, this firm does disclose additional information, including the specific selection criteria and a list of comparable firms chosen to get that range like $31 to $33 to $51. So in this case, we can see the additional disclosure does not change the valuation range itself, but the additional disclosure does provide more information, like how exactly the investment bank come up with this valuation, and what is the set of comparable firms, and what is the selection criteria. So here, specifically, the firm disclosed JP Morgan determined, based on its professional judgment, the ratios, this is a multiple like future value is a future value EBITDA multiple. So the investment bank basically select all the firms that within this positive multiple and less than 20 times to be included as comparable company. So we get our data by hand collecting. And when I was listening to the first paper using really machine learning, very the high-tech methodology like graphical mining, and I was thinking, okay, this is the perfect ending for our session because our paper goes to the other extreme. Our main data collection is by hand, and later on I'll talk about our another approach to address endogeneity, which is very different from this deep machine learning as well. So what we did, we basically collect all the comment letters, and we go through the issues. We calculate like how many issues in each comment letter, and we categorize each issue into those groups, and we find the most commonly commented issues are fairness opinion valuation, like investment bank valuation. Almost half of the time in a comment letter, those comments contain something related to investment bank valuation. And the other very common area is the background information disclosed in the proxy statement. So we call this like valuation. Fairness opinion valuation is deal financial information, and there are also like non-financial information. For example, this background mainly describes what happened during this private negotiation process, like how the deal was initiated. Did the target approach the bidder, or the bidder approach the target? Did they talk to anybody else in addition to the winning bidder? So it has a lot of information. So clearly, SEC cares about two things: the valuation provided by investment bank in connection to this underlying merger and the process, how the merger happened, initiated, and from initiation till the public announcement, what the steps the board of directors experience. So have they done the best job, like the best effort in terms of maximizing shareholders' wealth? So those two are the most a common area that SEC really closely look at. And we also find not every M&A deal gets a comment letter. In fact, only a little bit more than 30% of the deals receive comment letter. And majority of the deals, they do not receive comment letter. So firms do not have to respond. Intuitively, those deals can go through more quickly. And we do formal analysis later, like how this comment letter review process, to what extent this review process delay the deal completion. So the first deal outcome we investigate is deal completion. And ex ante, what is the effect of the review process on the probability of deal being completed is actually not clear. The direction can go either way. On the one hand, as in the example I just illustrated, the additional information can increase information transparency, which can reduce the disagreement among investors. So more information, better information transparency, reduce disagreement among investors that can facilitate deal completion because as I illustrated in the timeline, when the deal is publicly announced, the bidder and target already reach agreement. So what needs to be convinced is shareholders, particularly on the target side. So if target shareholders have high disagreement on the value or offer price, and the deal needs to be completed only if majority, sometimes supermajority of the target shareholders approve the deal or vote for the deal. So if additional information, more higher information transparency helps to reduce the shareholder disagreement, then that helps to facilitate the deal completion as suggested by prior literature. However, on the other hand, the newly disclosed information could generate even more disagreement, or maybe even introduce renegotiation, or the review process delay the negotiation time, which could, for example, what if the market condition fluctuates, which can negatively affect the deal completion probability. So ex ante, how the review process or the additional information disclosed because of the comment letter, how does that affect deal completion is not very straightforward prediction. So we empirically test and we find very strong and robust results. Receiving a comment letter is positively associated with the likelihood of deal being completed. So there's a positive relation between receiving a comment letter and the deal completion. And economically, this is quite significant because on average, only 11 or 12% of deals that do not go through. So the failure rate is 12%, and getting a comment letter improves the deal completion rate by about 4%. So that's to us, we interpret that results as quite economically significant. So immediately people can think of you have this concerns of reverse causality, because issuing a comment letter is not a random choice, especially only 30% of deals are getting a comment letter, right? So SEC is not just randomly pick deal to issue comment letter. What if this is driven by reverse causality? And interestingly, this reverse causality actually can go either way. So on the one hand, if SEC is detecting bad deals, or if SEC is trying to catch the bad guys, then we would expect the deals that get comment letter are actually have poor quality, those are value destroying deals. Ex ante should have a lower probability of being completed. So if that is true, if SEC is selecting poor quality deals that should work against us to find any positive association between getting common letter and the deal being completed. However, on the other hand, we could argue if apparently this deal is not going through, like the deal is going to fail for sure, then why spend time and resource reviewing the filings, right? So the counter argument is, okay, maybe SEC is actually picking the deal that have very high likelihood of being completed. That's the deal we're going to spend resource and time and effort reviewing and get additional disclosure. So we're aware of this potential reverse causality concern, and we tried a few different approach to address this issue. The first one is we look at the merger arbitrage spread. So what does this merger arbitrage spread capture? So at the deal announcement, if the bidder is offering like $30 to buy the target, and normally the target price on the announcement day does not reach exactly $30, there is a gap called spread. Like if the offer price is $30, but the target on the announcement day, the target stock price normally stops at like $29 or $29.50. So there's a very small gap between the offer price and the actual target price. And that gap represents the market anticipation of the probability of this deal to fail or to go through. And those are so merger arbitrage spread basically reflects the sophisticated investors, like institutional investors, those arbitrageurs, their anticipation of the probability of this deal to go through. And we measure this merger arbitrage spread at the announcement. And at that time, no filing has been made. So this is a very objective measure to see if ex ante deals later get common letter are indeed like more likely to be completed or less likely to be completed, at least in the eyes of those sophisticated investors like merger arbitrageurs. And we find absolutely no evidence. So ex ante, the group that later get common letter from the SEC, and the group that later did not get common letter from SEC, they have extremely similar merger arbitrage spread, indicating like ex ante, at least the sophisticated investors believe they have equal probability of being completed. So the second approach, we just directly control for merger arbitrage spread in the regression, and our results are not affected at all. And the third approach, as I said, we didn't do any machine learning or fancy technology, and we visited SEC and we asked them what they have been doing and what's their incentive. And that was before pandemic. That was December 2019. So we were able to go to DC and talk to the staff there and communicate with them and say, do you guys actually select deals, and what are the factors? What's the selection criteria you guys are using? Do you consider deal completion probability at all when you decide whether to issue common letter or not? And interestingly, they assured us like they do not consider the merits of the deal. They do not try to evaluate if this deal is good or bad. And what they are trying to do is they just look at the disclosure and they think if investors can benefit from additional information, they would issue comment, or they issue comment letter and list the issues that needs to be addressed. And also, in fact, they assume every deal will be completed at the time the filing is made with the SEC. So that again increase our confidence. I mean, our results are not likely driven by any of those reverse causality, like ex ante selection bias, etc. So the second deal outcome we investigate is price revision. Our hypothesis or our expectation is if the common letter induce additional information disclosure, and if that information is credible, then that might affect the merger terms or the price renegotiation. And we do find a very significant association between getting a comment letter and the price revision. And this price revision works stronger for the positive revision. We do find weak evidence that getting a comment letter is also associated a higher likelihood of negative price revision, but the effect is much stronger on the positive side. So finally, we look at deal duration. We anticipate we're going to find significant results, and not surprisingly, the results are quite strong. Like getting a comment letter is associated with longer time between the announcement and deal completion. So economically, you receive a comment letter. If a firm gets a comment letter, the process is delayed by about 20 days, like 3 weeks. So the average time is like 131. 20 days, we can have our own opinion. Is 20 days economically significant or not? I tend to believe like 20 days is a pretty significant delay. So to convince the reader, the receipt of the comment letter is not likely to be driven by immediate variable. We spend some effort investigating the mechanism. So our conjecture is the association between comment letter and deal outcome is through additional information disclosed in those amendment filings, right, induced by the review process. So if that is true, we can test the market reaction around the filing of those amendments responding to the review process. So what we have done here is, if the information disclosed in the amendment is material enough to drive the market reaction, to drive the price movement, then we should find this significant association between the amendment filing and the price movement, around like 3-day price movement. So the dependent variable here is the absolute return, which we intend to capture the price movement, either positive or negative, because positive information is likely to induce in positive price movement, and negative information, as we show in the previous slide, is also related to negative price revision, can induce negative price movement. So we use the absolute value of price movement to capture the information content in those amendment filings, responding to the review process. And that's what we find. We do find significant price movement surrounding the amendment filing dates. So the rest of the paper is about robustness checks, because I mean, that's a very valid point, especially given issuing or receiving comment letter is not random. So we have to make sure the effect is there. It's not driven by some omitted variable or endogeneity. We have been trying very hard to come up with an exogenous factor that affect the comment letter. So we're trying to find some exogenous variation in the comment letter quality, and that has to come from the SEC side, because any factor that is related to like deal or firm characteristics are not a good factor. So what we do here, again, we talk to the SEC staff and we ask them. So we are trying to come up with a measure that can capture the review process, like the quality of the review process. So what we did is we asked them, do they have certain time period they are extremely busy? So our conjecture is, if they are extremely busy, they probably spend less time reviewing those merger filings, and they are hundreds of pages long. Initially, they respond like, we're always busy. Then we keep pushing them. Do you have any time periods like you're exceptionally busy? And they responded, say, in September, they're really busy because that's their fiscal year end. They have a lot of other things to do. And also around the annual proxy filings, like mainly in April and May, they have to review all the proposals initiated by shareholders, like all those proxy fights. The same corporate office staff have to review all those filings. So those additional workload definitely reduce their effort spending on reviewing M&A filings. So we use that as our exogenous shock, sort of exogenous, because we tend to believe like SEC staff are overwhelmingly busy during that certain time period. That reduce their review quality. That should reduce the information content or the informativeness of this review process. And that's kind of exogenous, and it's not related to like the synergy or deal quality or firm characteristics. So we use that as our instrument variable. But before the instrument variable analysis, we first look at like the common letters issued during those really busy times, and we find much weaker evidence, like the common letters issued during like those SEC busy times affect deal outcomes. So that is consistent with our hypothesis. It is indeed the review process that affects the deal outcome, because we find much weaker evidence if the review process happens to be in those really busy time periods. And that result is very hard to be explained by any like immediate variable from the deal side or the firm side. And we push further by doing this instrument variable analysis. So first we find during the busy time, SEC in fact issue less common letters. So not only the common letter quality is lower, but they just issued less common letters. So during busy time, they issued 26% of the deal, but non-busy time, they issued 33%. And that seems like a pretty good first stage association. Like the business affects the likelihood of getting a common letter. Then we do the second stage and our results remain robust. Okay, to conclude, hopefully, I think by now I have convinced you the SEC review process actually has a significant impact on the M&A process and ultimately the deal outcomes. So our results suggest the SEC intervention, like as an external regulator, like this external review does benefit shareholders, but significantly delay the deal process by about like 3 weeks. So our contribution, we think we build on the literature examining the consequence of the SEC review process, but specifically focus on this very unique setting in the M&A review process. So although this setting is very specific, we hope our results can speak to like a bigger, a broader picture, like to understanding like why those channels implemented by those merchant parties themselves are not optimal enough. And this external review process can actually improve the M&A outcomes. And that's all. And thank you. I'm very looking forward to the my discussant, Zheng. I know he knows a lot about SEC enforcement. So I'm looking forward to the discussion.
Thank you, Tingting. Thank you, Tingting, for the wonderful presentations. Now let's welcome Zheng from UBC to discuss this paper.
All right, thank you guys very much. 1 second, I hope I don't let you guys down. So good morning, good afternoon, and good evening to all of you guys in various places in the world. Lovely to see you all. It's been a while since we attend any conference in person, but this is great. So I would like to thank the organizer for having me to discuss this very interesting paper that's right in my research area. I know everybody always makes these jokes. I think like I need to make it right now. I'm standing in front of you, and between you and like your lunch, your dinner, or going to bed. I really need to make my discussion very short and sweet. That's what I usually do. I normally give 3 major comments and a few minor comments for the authors to consider. The discussion outline for today would be I will quickly summarize the paper, provide some institutional setting, and place a research question into the literature. And finally, I will give some comments and suggestions for the authors to consider. The authors, Tingting did a great job presenting. So basically, this study looks at uses the SEC common letters in merger and acquisition process to answer the following research question. Does and how the SEC review process affects M&A deal outcomes? They propose that the mechanism is as follows. Common letters may generate new value-relevant information via firms' disclosure amendments during the M&A process, which resolve disagreements among shareholders. They find that M&A receiving common letters have higher likelihood of deal completion and deal price revision. And they make the inference on implications as follows, that common letters reduce information asymmetry in M&As and have real economic consequences of disclosure regulations. So let's first take a look at some of the background of common letters. So what are common letters? They're essentially a form through which SEC staff members in the Division of Corporation Finance to communicate with issuers. Whenever the issuers file a mandatory or voluntary filings with the SEC, the staff member within the Division of Corporate Finance, they have the right to review the filing, and sometimes they do provide comments. And they issue common letters whenever they deem a filing to be materially deficient or require further clarification. Usually a common letter conversation, we usually say that, targets a particular filing, like 2005 10K filed by Lululemon. It's very specific. And each conversation could contain multiple common letters by the SEC and also correspondences by the firm. So it's a back and forth negotiation process, if you will. The history of common letters actually dates back all the way to 1933, since the inception of the SEC and securities laws. And the SEC didn't really do very much with this process until August 1st, 2004. They started to publicly disclose common letters for all the filings filed after August 1st, 2004. So why are common letters important in accounting? As we see in the past few years, there has been an emerging literature on common letters, looking at various aspects of common letters. I think initially, when Chow et al. Published their paper, the hurdle they were facing is why was common letter important? Because common letters actually is a form of regulatory oversight of financial reporting that the SEC exercises. Okay. Additionally, recent two papers by Duro et al. And Hutton et al., they find that public disclosure of common letters actually improves financial reporting quality and also aligns private and public enforcement. Very important, right? And lastly, some research has shown that common letters contain firm-specific and new information and experience some stock market reactions. So overall, this is a very important area and deserves some attention. Now, when we place this research question into the literature, obviously it has not been examined. And so to me, this study has a very clear contribution to the common letter literature. And I also think that the results have some potential implications related to the policy. And I liked the proposed mechanism. Also, I also have some questions about that. So this study gives me this important stamp on it, okay? So we passed that stage. Additionally, I think this paper is very well written, provides some detailed institutional knowledge. I personally very much appreciate the fact that it interviewed SEC personnel and gathered more information about this process. Of course, this paper, it seems like it has gone through quite a lot and conducted many robustness checks to combat potential endogeneity problems, which I also applaud to the authors. It's great to read all those. But to me, it's actually missing one big mark that they can easily resolve. And perhaps you don't need to do so many endogeneity checks anymore once you can narrow down the timing and content of common letters and amendments to support the proposed mechanism. So the authors propose that the mechanism for this effect to happen is that the common letters affect deal outcomes through disclosure and amendments in the M&A process. But to me, their tests are very indirect and hard to interpret. So it has been challenging for me to really understand how this process really works. But please allow me to use a figure to illustrate my point. Let's assume this dotted line represents the M&A process. So of course, a company would announce M&A, and the deal will start. And at the end, the deal will end either by completion or withdrawn by the company. During this process, the SEC can choose to review the following related to M&A. Okay, so let's say the SEC chose this particular filing and the review starts. During this review process, if the SEC staff deems the filing to be materially deficient or requires further clarification, they will start a conversation with the company. They will issue a common letter, then the company can respond to the common letter, which is called the correspondence. And if this correspondence does not, satisfy all the questions asked by the SEC can ask more questions as such till the SEC is completely happy, and the review will end. And depending on the year, usually the SEC releases the entire common letter process within 30 to 35 days. Not in 2004 and 2006, but in the remaining years should be like that, okay? So that's the timing of the common letters. Let's entertain the following example where this M&A amendment is filed right after the M&A announcement, but right before the SEC review start. I don't think we should count this as part of your sample, that the deal is receiving common letters, but this common letter doesn't really mean anything. It didn't really change the amendment. It's not associated with it, right? In the second scenario, we have this M&A amendment, which is filed right after a common letter or right after a correspondence to this common letter. In this case, we as audience would say, oh, it's very likely that this M&A amendment could be associated with the common letter or the content in the correspondence. It would be interesting or important for the authors to really narrow down the timing between the amendment and the common letters and correspondence. More importantly, it would be great if the authors can actually do a content analysis and establish the link in content between the amendment and the common letters or its associated correspondence. So this leads to my very first point, that because the author has made so many big assertions, and I do think there's a potential contribution of this paper, I would highly recommend the author to narrow down or nail down the proposed mechanism by looking at the timing of the M&A amendment and common letters or common letter correspondence, and show that the content between those two are very similar, okay? I think if you do that, you can easily avoid a few analysis later on in your robustness checks, although they're great. And I think, like, as someone who does research in this area, what I'm proposing is easily actionable. All the data related to the dates and the content are already in audit analytics. I know you guys already hand collected common letter content, but also there's taxonomy in common letter content. If you're looking further, I can help you with that as well. And I'm pretty sure the difficulty could be coming from amendments, which shouldn't be too much. You can easily download that from the SEC and do content analysis. And timing should be easily identifiable. By identifying the mechanism better, I think it can really broaden the contribution of the study, and also allows you to say something like, oh, you guys are providing evidence on real consequences of the SEC review process, which is a big contribution in this literature. But so far, I don't think you can say that, given the lack of mechanism. My second point is related to research design. That's actually closely related to my first point. To test the mechanism, the authors use the following OLS regression, where the dependent variable here is the sum of absolute 3-day CAR around all amendments filed in any M&A deal, if I understand the writing correctly. And the independent variable of interest on the right-hand side is common letter, of course, a list of controls. They find that common letter has a positive coefficient, which suggests that common letters provide new value relevant information. Actually, I've been having a little bit difficulty interpreting this result because without knowing the content and timing relative to amendments, I don't think you can make such assertion. And second, what does the dependent variable capture? You're using the sum of absolute 3-day CAR around all amendments. Not all amendments are related to common letters, right? Only a few of them may be related to specific common letters during the process. So you probably only want to use those ones in your sample for this particular test. And additionally, as you know, I think there is a large literature in finance showing there are many factors that could cause price movements around amendments, right? Like whenever a new bidder is coming into the game, whenever there's an increase in probability of completing M&A, and whenever there's a change in M&A like payment structure. So those factors should be controlled in this particular regression, but I don't think my version, you guys did that, but they are actionable items which can help you. And lastly, I would suggest the authors to take a look at the stock market movements around common letters, and in particular, the disclosure or public dissemination of common letters. So I understand sometimes, you know, there's a delay and could be after the deal completion, but it would be nice if you can provide some kind of consistent evidence that the common letters are moving similarly with amendments, right? So that can help your story as well. My third main comment would be some confounding effects that you could consider. So the first possible confounding effect I'm identifying is SOX, section 302 and 404. They gradually rolled in, which actually changed information content of common letters because there has been a lot more about internal control weakness, and some of them are related to M&A transactions too. So you perhaps want to exclude those time period and make sure your results are consistent. Additionally, there's another important time period that's overlapping with SOX 302 and 404 rollout period. It's from 2004 to 2006, which is kind of like a learning period. And no common letters were publicly disseminated at all from August 1st, 2004 to July 1st, 2005, due to some technical difficulty. And from July 1st, 2005 to I think like May 1st, 2006, the SEC was learning how to disseminate what's the best practice. So Hutton et al., this recent paper shows that there's a learning period. So you also should consider like deleting deals from those periods as well. So because like, you know, they will affect your potential learning channel you're talking about, okay? The second possible confounding effect would be, are there any changes in M&A underwriter quality over time, or any differences in M&A underwriter quality between the common letter sample versus no common letter sample, because they could potentially lead to different outcomes that you are looking at, okay? And a few more minor comments. So I know there's another competing paper that's, you know, out there, but I think if you guys can add some longer term consequences after M&A completion, like class action lawsuits, SEC enforcement, restatement, AER, this can help tighten your story nicely. And I don't view that the competing paper, you know, it has any threat to your paper at all. You guys are looking at completely different things. So this is just additional thing you could look at. And those data should be readily available for the most part. Second, are common letters I have some questions about coding. Are they coded at the letter level and aggregated at conversation level? I was a little bit unclear in terms of writing that can be fixed easily. And also, I appreciate the authors providing so much institutional details in Appendix ABC. I think they're mislabeled in the text, and also in relation, in particular, Appendix B, which delineates common letters. I wish the authors could provide more details, because right now you're saying, oh, please go to Exhibit A of this company's filing. I don't really see any content from the common letter. So if you can, help the reader to better understand what you're talking about, this can save you some effort in the review process. Okay. To sum up my discussion, I think it's a very interesting and potentially important topic, and I think the findings have policy implications. My main point is related to better identifying the proposed mechanism, which can help really support and tighten up the story. And some of my comments are also related to research design, but that relies on the mechanism as well. So overall, I really enjoyed reading this paper. I wish the authors best of luck during the publication process.
All right, thank you, Zheng, for the wonderful discussions. Now, Tingting, do you want to respond to some of his comments?
Yes, first of all, thank you for a great set of very insightful comments. So regarding do the amendment level analysis, we have thought about that. I think that's a great suggestion. So currently what we have done is, and we are aware, during the review process or after the deal is announced and before the deal is completed, there can be more than one amendment filings. Right? There can be 2 or 3 or 4, and some of those amendment filings are voluntarily filed by the firm, has nothing to do with the SEC review process. But some of those amendment filings are specifically responding to the common letter issues. So what we currently do, you're right. We separate those deals at the deal level, right? We use whether this deal get a common letter or not, right? Without differentiate, within that deal, with getting a common letter, and that firm filed 5 amendments. So we have not tracked each amendment filing, see if amendment 1 is directly corresponding to the common letter and amendment 3 is not. So you absolutely had a good point. I mean, amendment filings that happen before the common letter issuance has nothing to do with the common letter. I think we have done some robustness check there. However, amendment filings during the review process, not 100% of them are directly responding to the common letter issues. So there, I mean, if we have to be really precise, we have to go through each of the amendment filing and see their response. Is that additional information disclosed? Is that directly responding to one of the issue in the common letter? So that I agree that will increase how clean the data, but that will I mean, undoubtedly, we probably have to rely on some machine learning technique to do that, because that's a significant amount of work identifying, tease out which, even the filings made during the review process, it's not 100% are responding to the common letter issues. But what we are pretty confident about our results currently is hey, we have some rough idea. We have 500 deals with common letter and 500 deals without common letter. So we can say for sure the deals with common letter, at least some of the filings are responding to the common letter issue. But the other 500 deals that do not get a common letter, those amendment filings are 100% voluntary. So we do have a treated group with a little bit noise, and we have a control group that we know 100% is not, the amendment filings are definitely not driven by common letter. Then we compare them and we find the voluntary amendment filings do not affect deal outcomes other than the delay the process, like other than duration, they do not affect the other type of outcomes. So that's like, we think, okay, but I agree with you, we can do better. And we will think about that more, but those are great comments and thank you for that.
All right, thank you, Tingting, for the response. Now I would like to open the question to the floors. Are there any questions from the audience?
So let me ask a question, if I could, please. I find this topic interesting, and I understand how your results can show that the SEC process generates information. I'm a little confused about how it provides evidence that it causes deal completion. I saw this stuff about the M&A, the busy period, but M&As don't happen randomly. Firms can choose when they undertake the M&A process. So I'm concerned, confused a little bit, don't understand how you provide evidence of that second part. If you could explain a little bit more there on how I should think of this part being causal.
Right, so basically you're concerned about our identification, like knowing SEC is busy in certain time period. Then we choose the announcement time and or the filing time. I think that's a valid concern. So we have some cross-sectional analysis, and hopefully that can help convince you a little bit. So we argue like the additional information disclosed, the mechanism is through to reduce the shareholder disagreement, and because their basically their action is required, like their coordination is required to effect the deal. So we separate our sample into like merger sample versus tender offer. So only in merger deals based on the structure, shareholders have to vote. There's a shareholder meeting, like majority of the shareholders need to agree. But for tender offer, they don't need to vote. They just tender their shares. Then we find the results are in the merger sample and no results in the tender offer sample. Like in deals that investors coordination is not required, then we don't find any results. So that's like one. I mean, I understand the instrument can never be perfect, and you have absolutely the right concern. I mean, firms are not. I mean, they're smart. They know if we know that certain period SEC is really busy, they may overlook, the review. Then firms can time in. That's a possibility. So we acknowledge none of our endogeneity test is perfect, but we have done a really broad test and collectively hope to convince this is the case. Another cross-sectional analysis we have done is we separate the common letter issues based on the valuation topic versus the rest. And we find the valuation, like common letter, because that's the mechanism we're arguing. You have to reduce the disagreement on the offer price among the shareholders, and that can increase the likelihood for your shareholders collectively to vote for the deal, right? And common letter has like 15 to 25 issues, and not all of them is related to the valuation and fairness of about the price. So we specifically test that common letter issue related to investment bank price valuation. And the result is strongest in that particular issue. Like our magnitude, like if you just use common letter dummy, it's like about 3.5%. But if you require that common letter specifically target on investment bank valuation issue, that magnitude increased to close to 7%. So all those cross-sectional analysis point to there is a real effect. Like it's not likely, like it's just picking up something else. I mean, it shows in the deal that requires shareholder voting, but not in tender offer deal. Like shareholder voting is not required. It also, the results become so much stronger if we don't use just a common error dummy, but we require that common error specifically target on investment bank valuation analysis. I hope that helps.
It helps a little. I have one follow-up question and then I'll be quiet.
Okay.
So you mentioned that you visited the SEC. I visited the SEC before as well. And so you rely a lot, it seems like, on this notion that they say they don't pick on deal success. Can I ask, why do you believe them?
You are absolutely right. I mean, I understand why you question what they say.
A lot. Sorry. Because if you do that, if that's assume from it that that's what they do, then I would never admit it, right? I would never tell anybody what my selection criteria is for selecting letters. I would say I select all of them, which is just like clearly not the case, right? I would never tell people I select on this. So why think that? Or maybe I just get it wrong.
No, you're right. I mean, in fact, they said they are not allowed to tell us what factors they use. They do have a model, but they're not allowed to talk about it. But what they could tell us was like, we do not pick deals based on like deal quality, if this is good or bad, or if we think this is going through or not. But you are right. This is just, we can't take their words as face value. Even they think they are doing the right thing, they could subject to behavior bias, like unconsciously they're picking something, even though they think they're not, but they could be doing something, even they're not aware of themselves. So we agree. I mean, at least that's like one piece of information we can get. I mean, if they say, hey, yeah, we are picking the bad guys, then that's a piece of evidence, right? If they're saying, no, we're not, then that's another piece of information, but we cannot like 100% trust what they say. That's why we introduced this merger arbitrage analysis, which we think is totally is coming from totally different perspective or aspect, right? Those are like the sophisticated professional institutional investors' expectation on the deal likelihood, like completion likelihood. Again, we don't find any evidence there. And that's, to me, is much a stronger test. And that actually is consistent with what SEC people told us.
Yeah, sure. We just have questions for, we just have time for the one last question, Zheng.
Oh, just a follow up on what David said. I think I was thinking about that comment as well. One thing you can do is to look at the subsample of your common letters and see who actually issued them. There's a common letter issuer fixed effect. So like within the SEC, how they work is that within the corporation finance group, there are specific reviewers with certain expertise. Some of them only look at or issue common letters related to M&A. Some of them only look at banks, for example. They're a very specialized area. So you could use them as a fixed effects or just see if there's any differences to at least get something, related to David's, comment.
All right, thank you, Zheng, for the last comment, and that will conclude our morning session. I would like to thank all the participants, presenters, and discussants for joining these sessions, and I hope you have a wonderful day ahead or have a good night ahead. Thank you so much.